people can also see it. Okay, so we are now.
Yeah, and live stream would be easier actually, right? So people will save them the hassle of, joining Zoom, registering, etc.
Yeah. So stream is live now. I am also going to open up the video so that we can see the chat box if it ever comes in. Let's see. Give me a minute. So while I do that, so if you want to speak to anybody, do anything, I'm gonna set up my chat
Okay,
box.
so welcome to all of you. Thank you guys for joining in, spending some time from your weekend, right? And happy Independence Day to all of you. And good morning, good afternoon, good evening, depending on which part of the world you are. So let's get started, right? So I'll quickly start with a quick intro, right? So on the
So my
professional,
take minute. Let's
uh,
so we are live on YouTube. Let me start recording this right before
yep.
you start the introduction. So give me a couple
Logistics first, right?
of just making sure everybody is able to come in, join, listen in. Okay, okay. So
In the
let
meanwhile, I'll check
me
my tweet.
yeah admit all. We are nearing 75 capacity here. We have people on the live stream. Okay, so I'm going to start recording this and I'm going to start sharing the screen. So all right. Now this is getting recorded
Okay,
and I'm going to share my screen. So, okay. Can everybody see the screen?
I can.
All right. Perfect. So, welcome everybody who's joined us from anywhere, India, US, or whatever time zone you might be in. So this is our webinar on how to run intraday straddle a trend followers journey with Soham and myself. So my name is Ankit Garg. I run Decibel Capital website.db.capital. Some of the systems we run there are trend following, mean reverting, or whatever you want to call it. But today's focus is not that. Today's focus is one on how Soham has went from being a trend follower to not I shouldn't say went but he adapted to it. So we'll talk about that. We have about 80 odd people in our live stream and Zoom, so we'll get started. First things first, so just a disclaimer, standard disclaimer that this is we're not sharing a system here. What we are trying to do here is we are sharing our knowledge. Sombai is gonna share his knowledge, his experience. So we'll be, all these standard disclaimers, disclosures apply here. By the way, am I audible, right? I don't know if I'm audible.
Yes. Yeah, you're audible, Ankit. Yes.
So this is just two of us, handsome pictures. We don't look like that in life, but nonetheless, this is good. So Soham, I've tried introducing Soham right now. So Soham
Hmm.
is he runs intraday trend following system. He used to run intraday trend following system, and now he's moved to straddle selling system as well. He's active on Twitter. He shares a lot of insights about trading, about different trend systems, how to assess, how to go about them. And the good thing about Soham is that he is very adaptive, and that's one of the reason I kind of reached out to him and said, hey, let's do this webinar, because he adapted from being trend following, purely trend following on intraday basis, to the wall environment or the low wicks environment. So in today's webinar, some of the other content that we usually deliver at Decibel Capital is quantitative in nature, is analytical in nature. Today it's a more bird's eye view. Before you go into doing any kind of analysis or any kind of data mining or model building or whatever you might want to call it, you want to do some bit of background research on your effects or what's going on in the market, having a better understanding of the market, right? So that's the expected focus of our webinar today. And with that said, I'll hand it over to Soham to take it up and lead it. I'll most likely be moderating this event, helping him out, but he's the one who's gonna talk about most of it. So Soham, over to you.
Hmm. Yep. Thanks for the introduction and disclaimer, Ankit. And welcome to all of you again. Happy Independence Day to all of you again. Right. So, thanks, Ankit, for putting up this nice slide. So, initially, what I did, I prepared a deck, right? Presentation, Microsoft PowerPoint presentation, but Ankit did not like the format. So, he converted it into a cool Canva format. And even my wife liked his version better than mine. So, we are sticking to it. Okay. Let's get on with a quick introduction. And one more thing before we start. Typically, I don't get a chance to speak for straight 45 minutes. Nobody at my home allows me to speak straight for 45 minutes without interrupting me. And none even in my, office calls or office interactions, typically I don't get to speak at length because most of those are like discussions where everybody participate. Okay, so without wasting much time, so let's get started, right? So a quick intro, right? So professionally, I'm a senior level manager in an IT firm, and my work primarily involves data management, right? So what you can say, all my life I've been living and breathing data, right? Now coming to market experience, right? So before 2020, I've only done some investment based on news, right, or some recommendation from friends, and I've lost significant amount of money by trading on tips. So after losing significant amount of money, to put it into real numbers, I have lost close to 7 lakhs, right? So after that day, I realized, okay, I'm not going to trade based on anybody's recommendation or tips. If I have to lose my money, I'll lose it my way, but there will be some learning out of it, right? So that's when my journey began. It was like late 2019, right? And honestly speaking, I started my journey by reading Zero Diversity, right? And I started with the first chapter. I still remember what was the first chapter. That was what is stock market, right? So that's where I started my journey from. So in summary, right? So basically, what I learned, there are three kinds of market or market regimes, right? One is the bull market, then bear market, and then sideways market, right? Now, now, basically then I was, because I lost a lot of money trading tips, and most of them were overnight positions, right? So from the day one I thought, okay, whatever I need to do, I need to do in intraday, right? So that when I go to sleep, I don't have to check Dow, what is Dow doing, right, or what is S&P index doing, right? So I don't have any hangover, right? So whatever is done, I will close my shop by 3:15 or 3:20, and whatever profit I make, whatever loss I make, I'll take that home and have a have a happy good life with my family, right? Now having said that, right, so that's where the I need to come up with an idea, and before coming up with the idea I need to decide on a instrument that suits my style, my temperament, my ideology, right? So that's when I decided, okay, I'll start with Nifty, because a lot of I've like after joining Twitter, I realized a lot of people are trading Bank Nifty, and a lot of people are making a lot of money as well, right? But somehow Bank Nifty did not suit my style, right? Because if I go to P and come out, the Bank Nifty will move by 200 points, right? That will give me kind of a heart attack. So Nifty is the first instrument that I decided, okay, this is my instrument, right? Now what next, right? I need to come up with an idea, and that idea I need to validate, right? How do I validate? Definitely I need to do some back test. So I bought data from GDFL, right? So I bought Nifty spot and future data. I spent around 15, 20,000 on that. And then I started validating my idea. And I was not a very good coder, right? A lot of people are like great Python coder I see on Twitter. But like I said, I'm most coming from a database background, data management background. So what I know was PL SQL, right? The old school PL SQL. So I dumped all the Nifty data that I bought into a Oracle database, and I wrote code to backtest my idea, right? And one more thing I'd like to add here, right? I'm not a great believer in any of the indicators that most of people uses, right? Nothing against them, but it's just that I'm not comfortable using them. Why? Because like if somebody comes and tell me, moving crossover works great, it works great if I use time frame 3 versus 5, right, on a 5 minute time frame or 15 minutes time frame, but it does not work great when I use 2 versus 5. That means it's not a good idea, right? If it something works on a 3 versus 5 time frame, it should work on 2 versus 3 as well, or 2 versus 5, or 5 versus 10 as well, right? So what I did, basically, Ankit, if you quickly switch to the next slide, please. Yeah, no, then the next one, please. Yep. Right. So like I was explaining, right? So there are multiple ways. So what I decided, okay, there are various ways to do intraday as well, right? Some people do trend following, some people do mean reversal, some people do option selling, right? So I thought, trend following looks like something where I can give it a try, right? Because I believe market will either go up or market will either go down, and there should be a way to identify that trend, right? So if we move to the next slide, please, Ankit. Right. Yeah. So what I decided, right? So breakout. A lot of people use breakout, right? So I'm also one of them who uses breakout, right? But at the same time, there are a lot of false breakout as well, right? So my initial idea was breakout, right? So I'll do breakout trading, right? But how do you identify which breakout, right? So there are various time frames that you can use. I know people using 5 minutes, people using 10 minutes, 15 minutes, 1 hour. So I thought maybe, 30 minutes is a good amount of time. And by 30 minutes, all the big orders get placed in the market and market kind of settles to a particular price, right? Now, if that price breaks, that might be a good time to take an entry, right? But then again, there are a lot of cases where we get false breakouts. And I know a lot of people uses different mechanism to negate the false positive signals, right? So what you can do, right? There are multiple ways to do it, right? For example, the breakout happens and then you're waiting for a certain period of time to see whether the breakout is sustaining or not. Then you entry. Lot of people do, okay, if the trend is up on various time frames, right? If it's up on 5 minute time frame, 10 minute time frame, and 15 minute time frame, then I do an entry, right? So I thought, okay, let me see what suits me. So what I thought is like, okay, if the breakout happens by a certain percentage, right? So for example, to put things into perspective, right? So let's say Nifty is at 10,000 right now. Nifty, sorry, the first 30-minute high is 10,000 right now. Okay. So what I do, I'll not enter at 10,001 primarily for two reasons. One is I want to negate the false breakout signal. Also, a lot of people do this for 5, 10, 15 minutes breakout, right? So there's a high chance that you will get a lot of slippage if you try to take an entry at that particular point, right? So what I did, okay, if the breakout happens by a certain percentage, then I will take entry. Now that certain percentage can be anything, right? For example, it can be 0.1%, 0.2%, 0.3%, right? So that you can decide, right? So that does two things, right? It helps me do two things. One is, right, to negate few of the false breakout signals. And secondly, it also helps me to save some slippage, right? Because a lot of people will try to enter at 10,000, but not a lot of people will try to enter at, for example, 10,010 or 10,015, right? And I do the same thing, right? When I take a short position, right? I check the breakout, and if the breakout happens by a certain percentage on the downside, I take an entry, right? And at the same time, what I do, I try to capitalize on the move, right? So because if the trend is uptrending or downtrending, right? So in that case, I make another entry, right? And again, the rule is same. If the if it breaks my first entry by a certain percentage, right? Let's say in absolute term, if it crosses my first entry by 30 points or 40 points, I take the second entry, right? And in both cases, I used to keep different stop losses, right? And again, stop loss is based on simple maths, right? Percentage, right? I don't check any other indicator, not whatsoever, right? And I started trading this system back after doing all the back testing and everything. I started trading this system back in 2020 May or June, right? But at that point also I was not trading the system, so to say, because I was making few tweaks, not in terms of my entry, because I never changed my entry ever, right? What I did, I changed my stop losses, other conditions, right? Position sizing, etc., etc., right? And since October, I moved to Tradetron, and since then I have been publishing my trade live, right? And I have even opened up my my system for subscription. And honestly speaking, I made good amount of money, and I used to take a lot of leverage. It worked in favor of me, right? So I started with close to 4 lakhs capital, and by end of 2021 Feb, right? So my capital was close to, it was not exactly 100%, but it was more than 90%, right? But, right, but what happened, right? Post March, what happened? The VIX started coming down, right? In accordance with that, my win percentage also started coming down, right? And I got into a DD phase, prolonged DD phase, right? So then the realization kicked inside me that, because when you look at the backtest data, right, there are certain uh, dips in your curve, but you don't care, right? Because you only look at the curve, right? How nicely it looks, the 45-degree angle or the 60-degree angle, right? Where you make all the money, right? But then I realized if I look at my 2017 data where the VIX was very low, right? So what typically happens when the VIX comes down, the volatility comes down, right? The ATR drops. So whatever movement, the max movement that you see in the first 30 minutes, most of the breakout that happens beyond the high or low, they are not sustained throughout the day, right? And that's typical of most of the trend following systems, right? You take any live running trend following system, I'm sure nobody will tell you their win percentage is more than 40-60%, right? Now, right, so having said that, right, you all need to understand, right, backtest is not a holy grail. We just backtest to validate our ideas. That's how I look at backtest, right? But I know there are certain people who swear on their backtest system, right? Like they're ready to ditch their wife or girlfriend, but they will never ditch their system, right? It's like a typical behavior. I don't understand this tribe mentality, honestly speaking, right? Because most of these systems are crap. I'm telling you, most of these systems are crap, and you see all this, big handles with 20K, 30K, 40K followers, right? They're preaching every day, right? Don't tweak your system. Don't tweak your system. Your system is a holy grail. But trust me, maybe, perhaps, right? These guys have some system which have been making money in live market for a long time, so they trust their system. But that does not mean it's applicable to all of us and all of you, right? Most of your system, most of the people who think they're system traders, including me, right? We are just, some of you have tested your system for 2 years, 3 years, 5 years, max 10 years, right? But what data you exactly have? OHLCV. That's all you have, right? And in most of the cases, this data is borrowed data. You don't even know the authenticity of the data that you are running your back test against, right? I mean, I would like to hear all of your views, but I am kind of doing, one-way communication, so I can go on and say whatever I have to, and I can,
Don't
put
worry,
stats and
let me respond to that because I think you've brought up a couple of very good points. And at this point, I'd like to tell the audience as well. If you have any questions or comments, what Soham is presenting, right? Either you are on Zoom or on YouTube, you can feel free to type in the chat boxes and messages your questions or thoughts, and we'll be happy to take them up, right? So to Som's point that backtest, not trusting your backtest or over trusting your backtest is one of the biggest perils in system trading, because a lot of time these back tests are not even fitted for in sample and out of sample. And I think we had that discussion on Twitter a while back, wherein I kind of show, I mean, I didn't show in sample and out sample difference, but the idea is that most of them are, usually curve fit, or overly curve fit or overly overfit to the data that is underlying. It's not even split into different regimes. And when you go live with that, that's why the challenge comes, that you do not know if it's not performing because something in the regime or something in the underlying markets has changed, or it's just that your system is not now, you fit that system, or you build a system on a certain set of history, and now the real life markets is not never going to be the same as the historical market prices or data, right? So, and that's the challenge, and that's why um, people are found blindsided by this. They go in thinking their systems is the holy grail, not understanding that their systems are mostly backfit or curve fit on the most recent history or the entire data history, and um, the live market is maybe different. So that's where Soham's Soham's approach also comes in. He kind of saw what's going on, like he was talking about the VIX falling and trend falling, changing.
वो बड़ा
And
वाला बैटरा कहाँ है?
um, hey, can you mute
Hey,
yourself,
Anil,
everybody
you need
who's
to,
not
yeah.
speaking? Okay. Uh, okay. So that's what I want. Sorry, I just wanted to say support Soham on that. So there's a
Just
question.
on that note, right? So just yesterday, I was having a offline discussion with one of my very good friend, right? Some of you might know him, Pawan, right? So in Twitter world, he is known as Logical Trader, right? So I was just having the same discussion with him yesterday, right? For example, right? Let's say, and the another thing is, right? So once when somebody say that I have tested my system over 10 years, 20 years, the more data you have, the more curve fit you can do, right? So that's another point, right? And when somebody, again, another point is, I have tested it for fives, I have tested my system across all cycles, and human behavior is constant, right? That's the one thing that you learn, right? Human behavior is something which is constant across all regime, right? So if something has worked in history, it will work in future. But bro, your accuracy of your system is over 30, 40, sorry, over 5, 10 years is only 40%. So are you then trying to tell me that human behavior is consistent across all these years of your backtest only 30, 40% of the time? Why is not 100% then, right? So the point I'm trying to make here is, right, your backtest might give you 30% win rate, 40% win rate with good RR ratio, 1:3, 1:4, but there is no guarantee, absolutely zero guarantee that in future is going to give you same outcome, because your win percentage or win probability can go down from 40% to 30%, 20%, even 10%. Nobody knows absolutely, right? And same thing can happen with your RR ratio as well, right? See, some of you might think that I'm twisting my words to back my point of view, right? But the whole point, driving factor that I'm trying to driving point here is, right, you should not give back test more importance than validation of an idea. That's all I'm trying to say here, right? Now we all love Tesla cars, right? Is there anybody who don't love Tesla cars, right? So let's say you buy a nice decent Tesla cars, you spend $40,000, right? And I think most of you know Tesla comes with auto driving feature, right? And I believe all of you would agree with me if I say Tesla engineers are one of the finest engineers in the world, right? So let's say you're driving one of these nice fancy Tesla cars, right, in autopilot mode, right? And okay, it's back test. They must have back tested the system, right? So let's say you're driving these nice cars in autopilot mode, right? And suddenly you see a person right in front of you, a kid right in front of you. What will you do? You'll apply brake, right? Or you'll just rely on your system because your system is back tested, right? The answer is obvious, right? You'll apply break. You will not just trust your system blindly. Because if you do, Tesla is not going to back up your logic, right? Because they have all the legal teams, they have all the legal clauses in the right place by which they can say that, I don't take any responsibility. Because if anything goes wrong, it's you who need to take care, right? So I'm just putting across this example just so that you all understand that, listen to everybody, hear everything, but use your own logic, right? Don't just go ahead with this herd mentality, right? If this guy is saying, he made a lot of money, right? He has 60,000 followers. Whatever he must be saying right. No, right? Absolutely no. I completely disagree. The whole point you are in the market is you are every day you are taking a position, you are taking a risk, and you need to see on the basis of which you are taking that risk whether that makes logic. That's the whole point I'm trying to drive here. Okay, enough gyan, right? So if people are, welcome to troll me on Twitter for whatever I said. If you disagree, right? So Ankit, please move on to the next slide, please. Yeah, so this is what exactly I was explaining a moment back, right? After March 2021, what happened? VIX came down, right? Low ATR, prolonged drawdown, and my risk reward ratio also came down, right? Now what do I do now, right? I listen to the same Twitter guru who preach that, stick to your system, no matter what happens, don't change anything. No, right? I will use my own brain. I will apply my own logic, right? I will see what's right for me, what's wrong for me, what will work for me, what will not work for me, right? And it's very easy, right, to see 20% drawdown in your back test, right? Nobody cares because eventually you see, okay, I made this much, 40% CAGR, 50% CAGR. But trust me, when you trade with real money and when real money goes out from your trading account, it makes a huge, huge difference. If somebody says otherwise, I mean, they're, I mean, obviously there's somebody can disagree, but this is not something that I'm convinced with, right? Especially, right, 20% of a 4 lakh account is different. In absolute numbers, if you apply this 20% DD on a 1 lakh or a 5 lakh account, it's a huge, huge, huge difference, right? You all can do the math and find it out for yourself. So that's when I thought, okay, I'll have to come up with a strategy that gives me better win rates, right? And that makes logic, right? And one of the primary person who convinced me to get into selling, I should name him, right, in live, and I really want to thank him. His name is Mr. Jitendra Jain, right? So we had a prolonged conversation, right? I still remember his words. He told me, Shrom, if you are not convinced, give me your money, right? If there is loss, I'll be at the loss, right? And if you make profit, give me some percentage out of it, right? But really I want to thank to him for guiding me in this direction. So let's move to the straddle part, the most interesting part that people are looking forward to, right? Is my video still turned on? Because I don't see myself on the screen.
Yeah, we can
Or
see
I
you.
can
Don't,
switch off my video
yeah,
as well.
we can see you. So if you want to switch it off, it's your call, but we can see you for sure.
No, it does not matter if you guys are able to see me. I want to see myself. Anyway, jokes apart. So see, so when I thought of joining the becoming a seller, right? So I started with a thought process, right? Because I already have a trend following system in place, which makes money when the market is trending, right? So now I need a strategy that will lower my time DD and capital drawdown, right? And definitely it needs to have a decent level of expectancy, right? So expectancy is what? In simple terms, if I put 1 rupee in market, how much money I'm making from that 1 rupee, right? Higher win rate, right? Everybody knows, right? Or when I say everybody knows, basically everybody knows on the basis of their back testing on stock mark, right? So option selling, straddle strangle gives higher win rate, right? Because there's one critical factor that works in favor of option selling. Most of you know that, right? Is theta. So theta is your best friend when you're doing option selling, right? So now how do I implement this idea, right? Now, if we move to the next slide, Ankit. Okay. Okay. So while you are trying to figure out what's happening in this picture, let me try to explain you, right? So first 30 minutes, right? What exactly happens in the first 30 minutes? Market is most volatile. Market is settling in, right? But at the same time, if you do option selling, first 30 minutes you get very good premium. And what happens if you get good premium? You get good decay, right? But then again, so it's a two-sided sword, right? But there will be a lot of whipsaw, right? And okay, I'll just take a quick pause before I get into these details, right? And I know Ankit might disagree with me here, right? I see a lot of people on Twitter, right, make a huge deal about option Greeks. Every day I hear some new terminology, right? Firstly, I'm not an expert on all the Greeks, and I honestly don't think you need to be an expert on all the Greeks to trade options, right? I mean, even with all the gyans, I hear all these new terms every day. Last couple of days back, I heard somebody saying option churn, right? I don't even know what that means, right? The point is simple. Driving point is simple, right? I'm taking a trade, whether I'm buying, whether I'm selling, what I am ready to risk, and what I'm ready to gain, right? And the simple thought process here is, let's say I start with the thought process, what if I lose everything in a particular day? How do I want to lose it? Right? So in the first 30 minutes, right? I know, right? Every one of you must be thinking, is it first 30 minutes? Does that mean 9:20? It can mean anything. It can mean 9:16, it can mean 9:20, it can mean 9:30, it can mean 9:45 as well, right? But this is the time when the market is volatile and you get good premium. So if I'm doing option selling, I want to make an entry at this point, right? But at the same time, like I said, there's a lot of volatility and there's a lot of whipsaw in the market. I will start with a small position sizing, right? So let's call it X, right? But because the market is volatile, right? So again, like most of you, I don't go by Greeks and I don't know a solid way to backtest my theory, right? If I have to apply all the Greek logic, right? Maybe it works for some of the trader who are doing discretionary trade, but for systems trader, I don't think there's any good way to backtest. I don't believe anybody has that amount of data. Even if they have it, I don't trust the quality of the data used by which you can backtest.
So,
And especially because I'm a system
sorry
trader.
to
Hmm.
Mumbai, sorry to interrupt here. I mean, I just wanted to bring an alternate point of view here, so that everybody who's listening and watching this can also make their own mind of how they want to use it, how they don't want to use it. So, like you said, I may not agree with not having the knowledge of delta or the Greeks of options as important or not. So, it depends on what you're trying to do with your portfolio or what your system. So, if you're trying to simply use options as a way to put trades on the trend following side, and I mean, you can get started without knowing much knowledge or without knowing much about the Greeks. But as our portfolio grows, as your sensitivity of your PNL changes, options is a very complex topic. And what Soham is sharing here is a very starting point for anybody who's starting in. They don't have to understand all the deep dives of Greeks, but then sooner than later, as you evolve as a trader, as your knowledge base grows, it's important to understand how the options are priced or how the options are changing their behavior, because an options premium price between two different regimes which have a high volatility or low volatility, expected volatility I should say, will not be the same, and your impact on PNL with the same kind of input signal, whether you want to go long or short, will change. So it's how you start off your journey and then how you grow in the field of systematic trading. That's also important. So I'm sure Sombhai, you would also agree, as we grow, you learn more and you set up more knowledge base, and you adapt your systems to better understanding of options and option Greeks is in my opinion, you may or may not agree, like I said, is fairly
No, no, I
important.
agree. I agree to the point that you need to understand all the things, underlying things that's driving the premium, that driving the prices, right? You need to understand, but at the same time, what I'm trying to say here is, right? I don't know a solid way to backtest a system based, where you can include all these parameters. That's the driving point, right? So eventually, what I'm trying to do here, right? Every time you're taking a trade, you are risking something. What are you risking, right? And if you, I mean, coming back to this diagram, right? So basically, what I'm doing here, right? First 30 minutes, I'm starting with a very small position. For example, let's say X is equal to one lot, right? But because the market is volatile, what I'm doing, I'm keeping my stop loss little away, right? I'm keeping it little wide so that it can absorb the whipsaw or the volatility that's there in the first 30 minutes, right? Now, what is my expectation in the, let's say everything goes wrong in the first 30 minutes. There's a lot of whipsaw, a lot of volatility, right? My C leg and my P leg both get butchered, right? Now, what I'm doing in the first and second hour, right? Between first and second hour, I'm starting another straddle, right? Now I'm starting with 2x capital or 2x position sizing here, right? Why I'm doing this? Because my basic assumption, because if we go back to the previous slide, you will remember that my first primary driving factor or the basic of my idea was that I need to minimize my drawdown, right? And I want to minimize my risk, right? So, so again, if we go back to the next slide, right? So what I'm trying to do with my second straddle, basically, if I had loss in my first straddle, I'm trying to cover that up, right? Because let's say market was uptrending and there was a lot of whipsaw, and from the second hour onwards market is downtrending, right? So that I can capitalize on that, that's why I'm changing my position sizing to 2x, right? Now let's say everything goes wrong by the time I get to the second hour, right? So in the third hour, what I'm doing, I'm again increasing my position sizing, right? So basically I'm expecting, okay, now it's already 12 o'clock, right? So hopefully market will, if it's taking a different route, right, perhaps it will stick to the same direction till 3:15, right? So that's what I'm doing with my position sizing, right? Now at the same time, as I'm increasing my position sizing, at the same time what I'm doing, I'm reducing my risk, right? Because I'm expecting as the day progresses, the volatility will decrease, right? This is just a hypothesis, by the way, right? We have seen multiple times that we get big spikes during 130, even 230, right? A lot of things happens, right? But somehow you have to start with an idea, right? So this was my idea, right? And this is the idea that I started with even before adding any credits to stock mark, right? And as you can see on the right hand side, the stop loss, right? So I'm moving my stop loss closer, right? So at every level I'm keeping a MTM level stop loss, right, in each for each of the straddle, right? And in percentage terms, right, because my y is higher here, right, in the first 30 minutes, that's why my stop loss is, MTM level stop loss is little higher in percentage terms based on my position sizing and risk per leg, right? And as the day progresses, I'm lowering my levels of stop loss, right, in percentage terms. I hope this explains, right? Now let's take some use cases, right? If we move to the next slide, right, so let's take some use cases, right? Now what happens, right? Typically, sometime what we see, one-way trending market, right? From 950 onwards, market is either uptrending or market is either in downtrend, right? So this way I can capitalize on the move as well, right? Maybe I'll capitalize more if I increase my position sizing in the first 30 minutes. But like I said, that's not the primary driving criteria for coming up with this straddle strategy, right? I want to minimize my risk, not maximize my profit, right? But at the same time, I want to make some money, right? It's not about only protecting my capital, it's also about making some decent money, right? So if this happens, right, if if market is completely uptrending, then all my P leg will be intact, right? And I'll capitalize on theta, right? At the same time, as the day progresses, because the market is uptrending, right, my P will be in the money, right? Because I started at the money. Gradually, they go in the money, right? So delta and gamma will also become my friend, right? And similarly, the same thing will happen if there is a downtrend, right? All my P legs will be cut and C will try to capture all the points, right? And I'll be like very super happy at the end of the day because eventually I'm a trend follower, right? I like trending market. That's how I look at it, right? Okay, now if we move to the next slide, right? Okay, very low wicks, right? Market is very range bound, right? And especially, okay, one thing again, right? I'm doing all this on Nifty, no bank Nifty here, right? So let's say market is only trending in a 50 range, right? And market stays in that ATM range throughout the day, right? So what happens, right? So sorry, I got distracted. So basically in sideways market, what will happen, right? I'll gain theta throughout the day, right? And I'll make money. If we go to the next one. So this is what I have done here, right? So basically, let's see what happens, right? Now, let's say there are a lot of stop losses hit on both sides, right? All my stop losses are hit, right? Only last C leg is pending, right? Now, had I done my, so let's say we are going ahead with one lot, two lot, and three lot, right? So total number of lots are six, right? So if I traded two lots during 30 minutes, first 30 minutes, another two lots in the first and second hour, another two lots in the second and third hour, right? So based on that, I have tried to put together some calculations on the right hand side, right? So fixed lot size of two for entry, right? So considering this is what happened, and let's say my, you know, for the first straddle, my stop loss was at 40%. For the second one, it was at 35%, and for the third one it was 30%. Again, these are just hypothetical numbers, right? I just tried to put these numbers to explain the hypothesis, right? So if we do the math, my total loss will come to 10,500 approx, right? Now with what I am doing, right, same thing, just the, if we do the change in terms of position sizing, right? So I'm starting with one lot, the next one is two lot, and the third one is three lot, right? So my total amount of loss, you see, is coming down from 10,000 to 8,400, right? So more the number of loss, more the capital, more will be the reduction in loss, right? Okay, so if we move on to the next slide, now what worse can happen, right? What worse can happen is, right, all my legs will be in loss, right? Everything will hit stop loss, right? And that is where my MTM level stop loss will come into play, right? And I typically keep my MTM level stop loss at 1 to 1.2% of my capital, right? This is again hypothetical, okay? You can derive to a different number that suits your personality, your style of trading, right? So essentially what I'm doing here, right? In worst case scenario, right? This is the worst case scenario, right? All my legs have been hit, right? Worst case scenario, I will close all the straddle with 1% loss for the day, right? Okay, now before we go to the next slide, right?
Bhai,
Now,
well, yeah, what is AKPC? If you can explain, what do you mean by
AKBC, right? I
AKPC?
think every okay. I thought everybody is on Twitter and everybody knows what AKBC stands for, right? AKBC days are like typical what we call it. Just use beep it, okay? ऐसे कैसे BC, right? So you are getting unwanted spikes throughout the day, right?
Right. So it's a day in which both, it's very range bound, and then your breakouts are not sustaining. The market breaks out and comes back, hits your stop, and then reverses, right? So if anybody who didn't know that acronym now knows it. So thank you.
Okay. Now, before we jump on to the next slide, right? So everybody talks about, so there are two ways to run straddle, right? One is manual and one is systematic, right? Now, every time you share a backtest report, right, on straddle or directional or trend following, means a lot of people will ask you how many stop, what is the slippage that you have considered, right? I mean, we get these questions a lot, right, from everyone. Now, the point is very simple, right? Why we want slippage? Why do we want to consider even slippage, right? See, I'm not getting into what is slippage. My assumption is all of you understand what exactly slippage is, right? So I'm not going to get, I'm not trying to get into the definition of slippage here. So this is what we try to manage through execution, right? That's why execution becomes very important for any system trader, right? If you're doing manually, I really don't have an answer how to manage slippage, but through execution you can manage slippage. And I have seen that, I have compared my live result with backtest and I have seen better outcomes. So there are multiple ways, right? I know a lot of system traders who applies various ways to when it comes to execution and reduce slippage, right? So Ankit, if you please go to the next slide, please. Right. So there is one way to reduce slippage is order slicing, and there are multiple videos on this topic. If you are very active on Twitter, you must have seen lot of handlers talking about how to handle execution, right? So order slicing is basically this is only applicable, right, if you are punching big orders, right? So if you're punching big orders, what you can do, let's say again, let's take the 920 famous example. You want to enter at 920. What do you do if you have to punch multiple like big lot sizes, right? What you can do, you can place chunk of orders, right? For example, 10 lots or 20 lots, right, every 1 seconds, right? So in a 1 minute time frame you are executing all your orders. So typically what will happen, some orders will get executed at the open price, some will get executed at the high, some will get executed at low, some will get executed at close, and other orders will get executed somewhere in the middle, right, in that 1 minute OHLC data, right? So overall we can assume that you will get an average price. Now, having said that, right, now it again depends on your broker, right? For example, if you are using Zerodha as your broker, right, your cost will shoot up because Zerodha does not charge you per lot, they charge you per order, right? So both the number of order you placed, your cost will go up. So with Zerodha, what will happen? Whatever you will save on slippage by order slicing, right, you'll spend more on the cost, right? And then there's the other way of doing it, right? What people do, they try to do, they try to place a limit order at OHLC average, right? So what is OHLC average? So let's say you want to enter at 920, right? But you know that there might be a high risk, high slippage if you just if you just place the trade at 920 open, right? So what they do, they will take the open, high, low, and close and divide it by 4. So what you get the average price, right? And you chase that price for a particular time frame. So let's say you chase it for 1 minute, 2 minute, right? It depends again, right? From trader to trader, right? And worst case scenario, in most of the cases, perhaps your order will get failed. If it does not, then you have no other option, right? You have to convert it into a market order and place the trade, right? Okay. And there might be other ways to do it, right? But I'm not going to explain everything, right? Now I'll quickly explain what I try to do, right? So what I'm doing here, I'm selling and buying, right? So when I'm selling, what is my intention? I want to sell high, right? The higher I sell, the better it is, right? And when I buy, I want to buy at the lowest price, right? Now, for example, I have done back again. Let's stick to the 920 example only, right? So let's say I have back tested my strategy and I open my straddle at 920, right? So what I typically do, right? I check the open price, right? Let's say it's 100, right? And based on my back test and observation of chart, I know if I place a limit order of 100 and at 101, right? 99 out of 100 times it will get failed, right? So I'll place a limit order, for example, let's say at 101, and I'll keep checking whether that order is getting filled. So I'll keep checking at a regular interval, for example, let's say 2 seconds, right? And I will try to do that for 1 minute. If the order gets filled, well and good, right? I'm very happy. I got a good selling price, better than my expected price, right? And if not, I'll again convert it to a market order. It might happen might get a big slippage, right? My expected price was 100, but let's say my order got executed at 95, right? So I lost 5 rupees here. But over a period of time, if you look at the big picture, if you look at the 30,000 feet view over a number of trade, right? 100, 500, or 1,000 trade, I'll save more on the slippage, right? That's what has been my observation so far. Similarly, on the exit side, right? Essentially I'm trying to do, I'm trying to sell low, right? I buy high, I sell low, right? That's my intention. Typically, right? If you're I'm not a Marwari, but if you're a Marwari, you will understand, right? Typical business. That's how you do business, right? So here in that case, I do similar things, right? If my target is 100, right? So I will try to place a limit order at 100 minus X. For example, 99 here, right? And I'll do the same thing. I'll keep checking my condition every 2 seconds. And if the orders are not getting filled even after 1 minute or let's say 2 minutes, right? I'll convert it. I'll become a obedient guy and I'll convert that order into a market order and accept the slippage happily, right? So that's all I had in terms of covering, right? So Ankit, I think that might have, I was not following the screen, so we might have received few questions. So let's open the forum and we can take questions now. Unless you want
Yeah.
to add anything. If you want to add anything, please go ahead and talk about it, or else we can start taking questions.
No, sure. So thanks a lot for your insight. So everybody who's joining in and listening in, one thing I think Soham very categorically explained on his Twitter when he shared this was that he's not sharing a system here. What you should try and take away from this is the approach to building a system or to going from one side of another. So all the different aspects he talked about so far, be it the position sizing, be it the execution, be it the overall system cap. Those are all, what do you call it? Building blocks of what you can use as a strategy. And the idea was never of this webinar was never to give a strategy. I mean, you would know anybody who's what they solved and have a winning strategy will not share it. Definitely not for free, if anything else. So we have a couple of questions
One thing
here.
I would like to, yeah, before I take question, I just want to add one more thing. Right. So few of you might question me, right? So the strategy or the concept or the idea that I explained on Straddle, right? It will need a lot of capital. Minimum, basically, if I do six Straddle, so even with current leverage, right? So we will need around 6 lakhs of capital, which might be huge, or a lot of people might not trade with that much money. But let's try to understand one thing: option selling is never supposed to be cheap, right? So don't think of running any option selling system with low capital, because I just few days back I explained in a tweet, right? So before even you start your strategy or run your strategy, you are at loss, right? Because cost, you're paying around 3,000 cost, right? So if you have a 1 lakh capital, before even you start, right, you are at a loss of 3%, right? Because your transaction cost is going to be around 3,000, right? Even if you consider like 150 cost per day, 150 into 20, that comes to 3,000, right? And then again, if you're running it systematically through APIs, few of the most of the known ones, they charge a fee, right? For example, Zerodha charges 2,000 rupees. So 3,000 plus 2,000, 5,000, right? So you're starting with negative 5%, which does not make sense at all. But as your capital size increases, this 5,000 becomes a smaller percentage, right? This 5,000 cost on a 10 lakh account will be 0.5%, which is not significant. But on a 1 lakh account, this becomes 5%, which is very significant, right? Yeah. So let's take questions, Ankit.
All right. So I have questions both on Zoom and YouTube. So let's start with Zoom's question. SK Rahman Bhai is asking a couple of questions. So let's start with the first one. I see that what is the level of automation required? Can you do this 100% manually? I think his question might be around the execution slide. So Soham Bhai, what are your thoughts on that? So I'm not sure if
Hey guys,
uh,
sorry, I was on mute. I was on mute.
yeah, sorry.
Okay. So if I understand your question correctly, right? Yeah, everything is can be automated, right? Automated is nothing. So what exactly we are trying to do? This is a logic. We need to apply this logic in a piece of code, right? If you are good at coding, you can do it yourself. If you're not good at coding, there are a lot of people who are creating algos, automating systems, right? You can reach out to them. If you don't know anybody, please shoot me a DM. I'll send you contacts who can help you, customizing your algo based on your need, which will give you better execution. I hope I answered your question.
Okay, so we can move on. I mean, we can keep on getting answering questions so that more people get chances of asking the questions, and then circle back to any follow-ups. So the next question is from Kunal. The question is, do you keep stop loss on single leg or combined leg SL? So maybe it's this one.
Again, guys, this idea here, we are not sharing a strategy, right? So see the idea, right? So if even if you look at this, if we go back to the previous slide, yeah, the one before, नहीं इससे दो पहले वाला, I think, yeah, 2 slides back, one more, yeah, right. So you take a look at this picture, you will understand, right? So when I am saying y percentage, this y percentage is applicable for both the legs. When I'm saying y percentage by one, so basically I'm reducing my risk, per leg in percentage terms. So that applies to both the legs. Same for the third straddle.
Okay. Next question is again from SK Bhai. He's asking market orders or limit orders for your execution.
Limit orders, like I said, market orders. That's what I explained right in the last slide. That if I want to place an order at 920 open, I'll check the 920 open price and then I will place a limit order at open price plus rupees X. Now this X is again something that you need to define for yourself, for your strategy, right? It can be plus 1 rupees, plus 2 rupees, it can be 50 paise, 20 paise, right? It can be anything. But what I'm essentially trying, I'm trying to get a better price for my sell order, right?
Okay, thank you. Another question from Kunal is that on expiry day, if we exit our stop loss hit position at limit, it is going to result hell lots of slippage. So I think he's saying if you exit your position with a limit order on expiry days, there might be a higher slippage.
Again, it depends on the instrument because primarily I trade Nifty. See, there will be firstly two things, right? One is instrument, right? You'll have to understand which instrument you are trading and what kind of limit order you want to place, right? So with Nifty, because I've been running this system only for a little over a month, and with such low weeks, I have not seen much deviation in terms of execution. But with Bank Nifty, you might see higher slippage, right? But then again, I've never tested a Bank Nifty system, so I'm not a good guy to respond to that question.
Okay, so the next question is coming from Rajan. His question to Soham is again, premium varies depending on time to expiry as well as VIX. Do you stick to your simple stop loss per side or change by premium or day? So basically, is your stop loss variable on the day on the VIX, or is it defined or predefined as you explained?
No, actually, this is something, where I did not want to make the presentation too complex, but it has to be different. It has to be different for different days, right? And your risk also needs to be adjusted accordingly, right? So, for example, let's take the expiry example, right? So let's say your both legs are running in one of the straddle, right? Market is uptrending and your PE leg premium right now is at 10, right? So now, and let's say the time of the day is 1 p.m., right? So how much time we have? We still have 2.5 hours. How much the premium cannot go below zero, right? It's expiry day. So the max you can gain is uh, 10 rupees, right? In the next 2.5 hours. But at the same time, let's say your call premium is standing at 30, right? And you opened this straddle when your call premium was, let's say 20, right? So your call premium is at a loss of 10 points, right? And let's say your defined stop loss is 40%, for example, right? Is the first straddle of the day, right? Now 40%, so how much you can gain? You can gain only 10. And how much you can lose uh, on top of this 30 premium on the call leg, right? If you add 40%, kitna aata hai, Ankit? I don't know. I'm bad at maths.
$8, 40% of 20, right?
40% of, yeah, 20.
Eight.
28, right? So
No, no.
maybe I chose a wrong example. Let's say the premium was 30 or 40. So basically your risk is still, let's say, more than what you can get rewarded, right? So based on that, you need to adjust your risk, right? Because it does not make sense you are risking 20 rupees where you can only get 10 rupees, right? So you need to keep adjusting that. I hope I
Okay.
answered your question.
Somebody, if Rajan, if you have any follow-up, please ask in the box. We'll move to the next question. SK Rahman is again asking when to switch this week or other. I'm not sure if I follow that question.
No, I think
Um,
what he's asking, like, I mean, let's say today is expiry. So if we have to sell straddle or strangle, should we sell today's expiry or next week expiry? I think that's what his question. See, what I typically do, I sell this week only, right? So Friday comes, I start selling the next week.
okay. And I think another comment is on the previous question that can you run this manually only or can this be automated? But I think you have answered that question, Soham,
I've
that
answered
there are
that,
ways to
right? Yeah.
make it automation, right? Okay, cool. So Jay is next asking if a stop loss gets hit on one of the legs, do you close the entire straddle or do you let the other run and add quantities to that leg on the next hour? So I think Jay is trying to get some clarity on how you would handle your positions as the first slide that you shared, right? So when you enter, if
Mhm.
something gets hit when whereas the other one is still open, how do you handle that? That might be useful.
No, so I basically let my straddles run as per the strategy, right? So basically, for example, in the first 30 minutes only, my call leg got hit stop loss, right? So I think you are trying to ask is shall I sell more puts? No, I don't do that. I don't do that unless the time comes in the first. I mean, based on let's say I want to enter the second straddle with 2x at 10:30, so I'll do that at 10:30 only.
Okay. Then another question from Samir is, should we trade on round figure strikes like 16,400 and 16,500, or do you also trade the 450, 550 or the mid strikes as well?
Typically, I go with ATM because if you are trading ATM, right, it always have good liquidity, so that should not be a problem.
Okay. I have a question, a couple of questions on YouTube as well. So let's see. AKBC, we've already answered the question. See, somebody's asking the order execution that you shared. Ankur is asking the order execution that you shared. Will this work on the breakout strategy as well in Bank Nifty option buy? So I think they are trying to understand the execution bit that you explained. Is it applicable only to your straddle selling, or can something like this be done for a breakout kind of a strategy as well?
See, typically when breakout happens, it basically it the price movement becomes very volatile, right? So if you're exactly trading breakout, I think it will be a challenge for you to place a limit order. And again, when you say the instrument is Bank Nifty, right? So it might be a challenge. I'm not again 100% sure. You'll have to test it out. You'll have to test it out because you'll have to see the charts and see okay whether what exactly analyze the chart over a period of for the last 5 6 months and see when you are entering how the price movement is happening. Does it really make sense to place a limit order? And if you place a limit order, what exactly is the probability of that being executed? Test it out, please.
So, Soham, I can actually add some thoughts here. So, trading on
Mhm.
breakouts using limit orders is definitely possible. It needs to be, for ideally, you would want to automate it unless you're trading manually and, quickly updating your orders. Over the long run, you should, if you, at least if you are using an execution algo, you should be able to get a better return. But then, this is just a should. It really depends how, when you're building a system of breakout, what kind of breakouts is it taking? Like, for example, if you are trading breakouts on the first 10 minutes, then it's very, very expected that the volatility is so high that you might end up losing out on days when market is strongly trending, and you will get limit filled on days when the market is going to mean revert and come back. So, it does require a bit of testing. But I have seen both retail traders and institutional trading firms or institutional traders being able to improve, in other words, add a bit of alpha in their returns by having a good execution logic, a good execution system. It's just that when you are trading with small lots, your execution can only try and get you a fill of limit, and then try chase the market. Whereas if you're trading a larger capital and you have multiple lots to trade, you can actually do slicing and do much more sophisticated entry and exit work with execution. But for small orders as well, there might be some bit of enhanced returns that might be possible. So just wanted to add that to that. I'll go to few more questions. We'll probably wrap this up in the next 5 minutes. So we have a couple of questions. So Jay is actually asking your follow-up questions. So I think this is around whether when the stop loss hits, do you add on the loss losing side or not? So his question follow-up is, so at 10:30 you add 2x to both put and call. So I think he's again referring
See
to the.
again, don't take whatever I'm saying with a pinch of salt. When I say 2x, I does not necessarily mean it has to be 1, 2, and 3. It does not necessarily has to be in that proportion, but it's just the idea that I'm trying to plant in everybody's head, right? So it can be, maybe it can be 2, 4, 5, right? The ratio does not exactly have to work in uh, the way I have represented in the slide. Basically, what I'm trying to say here, I'm starting with a small position sizing in the first straddle. I'm increasing my position sizing in the second one, and I'm increasing it further in the third one. Right? That's essentially what the message I'm trying to send across.
We have two more questions on execution, and I think I'd like to pitch in as well. So, first question is from Rahul on YouTube. The question is how to handle API breakdowns during execution. And the second question is, I think, at the follow up, that if there's any website that provides execution algo. So, I'd share some of my thoughts as well here. So, Rahul, you're handling the API breakdowns is something, it's something part and parcel of automated and systematic trading. How do you handle them? Your code should be, if API breaks down, you can't, you have to have a redundancy mechanism in place wherein you either manually punch the orders or exit your positions and stop your algos. It's like, you're driving on a highway or you're driving over a bridge and the bridge breaks down. What do? You can't make that bridge. You have to wait for somebody to fix that bridge before you can do. The only thing you can do meanwhile is reduce your dependency on that, and take an exit manually if you want to. So API handling API breakdowns is not as trivial as somebody might want to believe. And the question
Right.
around, yeah, so Somai, any point on that?
No, I just like to add one bit to here, right? So if you're on Twitter, you see a lot of people, say, I'm an algo coder. I don't need to look at the screen, right? My algo does my job. I just go to Goa beach, sip beer. At 3:15, I check my MDM. No, it does not work that way, right? You'll have to constantly monitor, right? Something and anything can go wrong. There are so many unknown unknowns, right? Have you? I mean, most of you guys must have worked in IT or know somebody, a friend or family in your family who works in IT, right? A lot of IT people works in support, right? So what the support people do? Support people, all the jobs are anyway automated, right? But the jobs can fail. That's why support people always, wherever they go, right? Even if they are going for a drink, they will take their laptop because they never know when a pager will come and they'll have to log in and debug the issue, right? So execution error can happen anyway, even if you have Telegram alerts, etc., etc. Telegram alert will tell you there is an error, but you need a machine to log in and do something, right, with that error. It's not as easy as it sounds. Yes. Let's take the next one.
Right, thank you. So the next question from Shubham on, do you know any website that provides execution algo? I mean, we don't really talk about any websites usually. Execution algos. So there's the one popular one which a lot of people use. They don't have execution algos as such, but they have execution logic in it. So if you go to my website or Soam's Twitter, we used to have this facility wherein traders can use our algos over TradeTron. So they do provide a way in which you don't have to enter at the market. You can provide some bit of logic in it. Otherwise, execution algos are slightly more sophisticated to be sold on in an open market. Usually they are used by institutions. So somebody who's trying to enter market with some few crores of exposure at a given time, and it's not usually available for retail because it requires a lot of setup to have an execution algo up and running. Like we were discussing the API breaking, or Som was telling about non you have to keep on observing your system. So execution algos require a bit of monitoring, and that's why it's hard to find them in a retail setting. We have we have two more questions, and I think we'll wrap them up after that. So first question is from Karuna Karan Settler or Settlers. I'm sorry if I mispronounce your name on YouTube. Question is, why should we sell ATM option when one leg loss, leg loss will be more than the profit of the other leg? Yeah. So one leg loss will be more than the profit of the other leg. Why should we sell ATM?
I don't really get the question. I mean, why
Sir,
one
if you
like
are
stop loss
listening,
will be more than the profit?
can you explain that? It's a little confusing if you explain that while we take the next other question. So this is from Sandeep. Sandeep is asking, if your first 30 minute straddle is in profit, then do you enter the first and second hour straddles? So if it's already in
Yes,
profit,
yes, yes, right. Because by heart, I'm a trend follower, right? I would like to capitalize on the trend.
right. So then the idea is essentially you're scaling in, just like in trend following, you have the concept of pyramiding or scaling in, which is essentially, and you're putting on more risk. But I think Soham has already explained how he enters more risk into the position. All right, guys,
Yeah,
I think,
I was talking to somebody and somebody was saying yesterday, are you doing martingale? I said, no, martingale is something completely different, right? What I'm doing is not martingale because martingale is what? Because let's say you're taking trade every day, right? Every time you lose, you are increasing your position sizing, right? But here I don't know whether I'm losing or winning. I'm still increasing my position sizing, right? So in theory, it's a little different.
yeah, I mean, I think somebody asked that on the stream as well. So to explain the subtle differences, martingale is usually when you're averaging out your losers, or basically you're putting more exposure as market is going against you. What Soham is essentially doing by putting those three straddles is, you can think of them as three different systems being traded as one system. So he's entering the market at defined times, predefined times. So he has three systems, one in the first 30 minutes, then the next hour, and then the next hour. And he treats them individually of each other. At least that's what I understood from his webinar so far. Now you can aggregate them and say, okay, these are three different rules or three different patterns that I trade as part of my own system. And you can do a lot more analysis on how you can divide the risk. So you can have, if you're looking at correlation between them, if you're trying to choose between one of the three, you would want to decide a correlation. But let's say you are equally allocated, which Soham is doing. He kind of splits the risk across the three systems or three entries. In a way, if I understand it correctly, he's trying to mitigate the risk of entering at a specific time. So his analysis or his back test, whatever he might have done, is kind of telling him that there's some potential profits to be made if you sell straddles on a systematic basis. And rather than being pigeonholed in a specific time, he's saying, okay, I will enter at different times. This is how I will manage my risk, and this is how I will manage the positions, and I have an overall P&L loss, or the loss limit on it, to go ahead and trade that. So this is not really martingale, because you are essentially, like Soham said, you're not really adding on more risk as you're losing. Okay. So by any closing thoughts? I think we're done with questions. I hope we've answered all of them. Any closing thoughts from you?
Now, just one thing, right? I hope whatever time you spent here with us, it was worth something, right? There's some takeaway from the discussion that we had, right? And whenever you do anything, start with the logic, start with your own logic. Just because somebody on Twitter is saying start a straddle on Monday at 9:30:29, it does not mean anything, because he has only tested it how many times? Because uh, if we are all doing testing of strategy on the famous website, right? So how many days we have in a month? 20 days, right? Or for example, how many weeks we have in a year? 52 weeks, right? So there are only 52 Mondays in a year, provided there is no holiday, right? Over a period of 4 years, how many Mondays you have? 52 into 4, 208, right? So basically, you have tested your 9:20:39 straddle on Monday on just this data set, right? 208 days. And you're so confident that it's going to give you profit with good RR, good expectancy in future. That's just utter rubbish, right? So start with an idea, right? Don't look at all those fancy numbers, expectancies, 8, 9. Some people have more than one expectancy. Right? Don't look at all those fancy numbers. Start with an idea, right? And then improvise on that idea. I mean, think constructively. I mean, that's the message I want to send across, right?
Perfect. No, this is very useful. I hope anybody who watch this, they have follow-up questions. They can always reach out to Soham for his methods, his systems, or whatever he is doing. I also am active on Twitter. I also share some thoughts. Feel free to message or reach out to us. I think Soham is definitely very helpful. He's always eager to answer questions. I know that for sure. So thank you, Soham, for your time. Thank you for sharing your this journey with everybody. And with this, by the way, I've already answered. This is on YouTube. This will be uploaded on YouTube for somebody who's not uh, seen this so far or not was not a part of it. But thank you, everybody, and we'll close this out. Thank you.
Thank you, everyone. Thanks, everyone, for joining.